I'd really just like to do three things today, which is I'm going to start by talking a bit about demand and prices in global gas. And then I'm going to move on, secondly, to an aspect which I think is extremely important, which is the political economy of gas on the ground in the countries that use it. And I'm going to make the point that the details really matter and that they vary very widely across the world. And then thirdly, I'm going to talk very briefly about something that I call strategic positioning in global gas. So my first point is around demand, and I should begin with an apology that I'm using the term forecast slightly too loosely here, I realized following our discussion today. So what I really mean is projections. And what this slide does is it shows projections of global gas demand collected across a number of different organizations, including the IEA, also the EIA, BP, and Shell. And so this just plots world demand in BCM from approximately now up until 2035. And so the situation for gas across the board, across different scenarios, is pretty positive. So it's very widely projected to grow by around 2% per year. It grows faster both than coal and oil, and within the gas sector, LNG grows disproportionately quickly. As we've heard earlier today, this is very much driven by action outside the OECD, and in particular in Asia, and in particular in China. And a lot of that is really catch-up potential. So that's where the use of gas in the economy is relatively low, and compared to the rest of the world, so it can be interpreted as scope for catch-up. And so it's also sort of worth noting that these these projections have stayed pretty similar over time. In 2011, there was a lot of attention paid to an IEA scenario around the golden age of gas, and I think which obviously was a relatively sort of positive projection. And I think the projections we have today are still basically quite similar to those. And I think that raises important questions from the viewpoint of gas. So in particular, in a world of increasing levels of decarbonization, how can these demand levels be secured? And moreover, at what prices will they be secured? You know, ultimately, this is not about demand. It's about actually creating and capturing economic value. And also, you'll know that there's been a lot of investment recently, especially in LNG. Can those investments will they be justified? And what is the scope for justifying new investment? Let me move on to prices. And the point I'd like to make here is that historically in the gas market, there's been very significant price divergence across the world. And what the chart here shows is the gas prices as measured by an LNG price in Asia and by the Henry Hub price in the United States. And I've plotted this in a way that it's relative to the European gas price. So this shows a premium or a discount relative to European prices. And you can see here at the top that on average since 2000, so approximately over the last 20 years or so, Asian prices have been almost 40% higher than in Europe. There's quite a lot of volatility, of course. There was a brief period around the financial crisis where prices were pretty similar, but there's a very substantial premium on average. What's that been driven by? So some of the research I've been involved with argues that it's driven by two things. On one hand, demand conditions vary a lot in Asia compared to other places, and also this remains a very imperfect market. So it's far from the economists' ideal of imperfect competition. There's some large players in this market, and they might not always have an incentive to fully arbitrage prices in a way that would happen under perfect competition. And that can exacerbate some of the price differentials that we see across the world. Of course, in absolute levels, prices have come down a lot since 2014, since the oil price crash. So the balance of power, if you like, has shifted from sellers to buyers in this market. And one of the key stories going forward is what's happening in the US. So you can see here that, again, gas in the US used to be quite expensive. But since 2009, thanks to the shale revolution, prices have plummeted. And now, as measured by Henry Hub, the prices are very low. And they've also been pretty stable. And there's an expectation that they will continue to stay low, even as the gas production is further ramped up. That's opened up a very powerful window for US LNG exports, which are great news for security of supply around the world. They're based on different pricing models, so where instead they're essentially based on US domestic prices plus a markup. And we've already seen that access to LNG can put a lot of pressure on pipeline gas. So we've seen that in the case of Lithuania, where they used to be entirely dependent on Russian supplies, and prices have already gone down, perhaps by unexpectedly much. And also in future, it will be very interesting to see how this plays out in China, because of course, from the early 2020s onwards, there will be additional pipeline connections from Russia, and they will then be competing head-to-head with US LNG supplies. Some people have suggested that this might lead to a future of a global price convergence anchored at Henry Hub prices. Let me move on now to the political economy, and I'm just going to highlight two different cases, the first of which is the UK. And the point I'd like to make in the UK is really that carbon prices have been very important, and they've also been important specifically from the viewpoint of natural gas. So what the graph shows here is that electricity demand is sort of moderately declining in the UK, as it is in other places. But over the last few years, coal has been squeezed very strongly. I should say this is in the power sector. And indeed, a coal phase-out has now actually become a specific government policy objective. And now the latest date is 2023, so in 5 years, a complete phase-out of coal from the power sector. I like to think about this in terms of carbon prices, and let me just highlight some of what I think the key metrics are. So there's the social cost of carbon, which is an economic measure of the global costs associated with climate damages. And there's another metric in the policy literature called the target consistent carbon price, and that's essentially the carbon price that is needed to deliver climate targets in future. And in a sort of over a nearer term horizon, these are just ballpark numbers. These are roughly $50 per ton of CO2. And it's interesting to contrast with that with the switching price. So what is the price at which it becomes economically viable or sensible to switch from coal to gas in the power sector? It's significantly lower. So again, the numbers vary depending on the particular country, the particular plant, somewhere like $20 to $30 per ton of CO2. So the point is, and this was mentioned earlier, I think in the last panel, something like a carbon price floor at approximately that level can be very powerful at delivering emissions reductions in the power sector quickly at relatively low cost. And that's one of the things that we've seen in the UK. And of course, there are ongoing discussions in other European countries. That should be complemented with good electricity market design. Many markets around the world are basically being redesigned as we speak in order to reward the flexibility services which are now in higher demand given the growth of intermittent renewables. And in the UK, there's some very successful initial work trying to use auctions more to reveal what kinds of flexibilities can be provided by now by a sort of more dispersed group of generators in the market, and indeed what sort of flexibility services are required. Okay, let me contrast the UK with India. So India is, in some sense, the polar opposite. So here, over the past few years, gas and LNG have really been squeezed out, both by coal and solar. And there's no sort of clear role for gas at present. The black line here is the share of coal in electricity generation, which is going up. The red line is gas. It's going down. Gas is not cost competitive against domestic coal. Domestic coal has a lot of political support. Support for LNG was recently actually cut because there was a sort of support scheme for the power sector which was discontinued. And so there's now, in India and perhaps also in other developing countries, a real potential of perhaps even skipping gas, at least to some extent, and moving straight from coal to renewables. India has very ambitious renewables targets, especially for solar. As we've heard, costs have come down at about 20% per year. Auction prices have recently been very low. So this kind of classic trade-off, cheap versus green, has been relaxed very strongly. And the point I emphasize here is that all of this has happened without a carbon price. So this is really renewables. Let me move on to the final point that I wanted to discuss, which is strategic repositioning. So we talk a lot about the energy transition, we talk about gas as a transition fuel and those sorts of things. I'd just like to highlight that the gas industry is itself in the midst of a transition. And what's very interesting is that different companies are responding very differently to what's going on. The energy majors, at least gradually, some of them seem to be drifting away from oil a little bit. They're investing more in gas and LNG, and even moving into the power sector, specifically into renewables. The electricity companies are doing other things. So some have actually already started to quite aggressively move out of coal and gas, and they're moving into renewables. At the same time, commodity traders have entered big time into gas and LNG in recent years in a similar way that they did in the oil market some years ago. And also they're new players, private equity, smaller players in LNG exports who are entering this market in different channels. So of the remaining players, I'm sort of asking, is there a trend towards either being a large integrated player or a niche specialist? And at least sort of basic economics would suggest that at least in a maturing LNG market, it should become less integrated because as liquidity improves, there's more scope for individual players to specialize in what they do best. And again, this might be driven by the US. So with that, let me move on to my conclusions. The first one, global price convergence in global gas markets, in my view, not anytime soon. I think that the imperfections in the market that I sort of sketched out that limit arbitrage across regions, perhaps they'll weaken, but I don't think that we'll go to a global price convergence anytime, certainly over the next 5 years or so. I'd highlight that there is potential for significant downside risk in gas demand forecasts and projections, and that's partly driven by difficulties around the political economy for gas and LNG. We tend to have quite a different view here in Europe from what's going on in Asia, in other parts of the non-OECD, and also, of course, compared to America. And finally, I'm suggesting that there is some strategic repositioning going on in the market, and that to some extent it reflects the different visions that companies have around the future of gas, and perhaps it also affects differences in their time horizons. And I've also included a number of references here by papers by myself and colleagues. And with that, I'll finish. So thank you very much.
Thanks a lot, Robert. When I read in Financial Times, the major gas companies like Shell, BP, and ExxonMobil, actually, they are very positive now in the way that they want to invest more in natural gas or LNG than in oil. Is that the picture you also see?
Yes.
Yeah.
So I think there's the oil market is obviously also in a sort of state of flux.
Sure.
But especially the growth prospects in LNG,
Yeah.
I think are quite favorably seen by a lot of the major players. So yeah.
Yeah, yeah.